You've got money ready to invest, but the age-old question is whether you put it in now or wait for the market to drop. Sounds like a simple question, but the answer could have a great difference between building serious wealth or just sadly watching from the sidelines. In this video, we break down two of the most popular investing strategies, buy the dip versus dollar cost averaging. We're looking at real data, a famous 20-year study, and the psychology that causes most investors to get this completely wrong. By the end, you'll know exactly which approach actually works and which one quietly drains your returns while you're busy feeling smart about things. By the way, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, one of the largest investment research platforms in the world, and now I'm a partner at WallStreetZen.com, where our quant team has built a system that analyzes 115 proven factors across 4,600 stocks to find the ones most likely to outperform. Before we dive in, if you find this kind of research useful, then hit that like button right now. It helps me out a lot. Appreciate that. Now let's get into it. Buy the dip versus dollar cost averaging. Is there a clear winner? Here's the thing. You've likely probably heard both sides of the debate a few times over. Investors who are fans of dollar cost averaging will tell you consistently beats everything. On the flip side, those who prefer buying the dip claim that waiting for a bargain is the superior approach. At times, the debate can be quite heated. That's because both camps sound quite reasonable and both have logical arguments, so it isn't exactly a straightforward discussion. And to be perfectly honest with you, both are partially right. But partially right isn't good enough because partially right is also partially wrong. So our best approach is to look at the actual numbers and make objective decisions based upon the data. But once again, the answer isn't as clean as either side wants you to believe. There's a surprise in the data, and there's a caveat that most investors never hear. We're going to cover both today, so let's get started with the basics. Dollar cost averaging is exactly what it sounds like. You invest a fixed amount of dollars at regular intervals regardless of market conditions. Monthly is the most common, but fine to do it weekly or quarterly, whatever works for you. Let's say you invest $1,000 in the first of every month into an index fund or a basket of stocks. It doesn't matter if the market is up 6% or down 11%, the contribution goes in on schedule, no exceptions. It's as simple as it is elegant. When prices are high, your $1,000 buys fewer shares. But when prices drop, your $1,000 buys more shares. You're automatically getting more value during the downturns without having to make a single extra decision. There's one thing to keep in mind here. The key benefit this isn't just mathematical, it's psychological. If you opt for dollar cost averaging, you've eliminated decision fatigue. There's no questions about should I invest right now? And that's the exact hill that most investors die on. It isn't necessarily picking the wrong stocks that gets you in trouble. Rather, it's hesitating for too long to take action. On top of that, dollar cost averaging is quite easy to implement. Once in place, it runs like clockwork. Is this approach perfect? No, of course not. No approach is perfect. We'll get in that in a minute. But first, let's talk about the other side of the argument. Buy the dip sounds the most logical approach because it feeds off the most common expression in all investing. Buy low, sell high. When good assets go on sale, you buy more of them. It's the same principle as loading up on your favorite cereal when it's half price at the store. So why wouldn't you do the same with stocks? The theory is simple enough. You're getting more shares for less money at the exact moment the risk-reward looks the most attractive, and thus all the more likely to see gains the market bounces back. But in practice, things get a lot more complicated because when is the drop done? Should you buy after a 4% pullback or wait for a broader 10% correction? Or what if it devolves into a bear market dropping 30 to 40%? This decision looks super easy in the rearview mirror, but not when it's happening in front of you in real time. How about this one? What if you wait for a dip and it never comes? History shows the market spends far more time going up than going down. The average bull market lasts over 5 years, meaning you can miss a lot of upside waiting for the next attractive dip. Plain and simple, the market rewards people who stay invested. Now, there's a version of dip buying that actually works pretty well, and it's not about timing the broader market, which as we shared is quite difficult. Instead, it's about identifying fundamentally strong stocks that have taken a temporary hit for unnecessary reasons. Even the best companies can get caught up in sector-wide sell-offs, leading to a temporary 10 to 15% reduction in share price. This happens even though nothing has changed in their business outlook. Those make for prime buy the dip opportunities because it's very important not to get sucked in by stocks that have dropped because the fundamental outlook has diminished, like a bad earnings report, those stocks will only sink lower. WallStreetZen has a buy-the-dip strategy that was specifically built around this idea. It scans for fundamentally sound stocks, meaning the ones with the strong Zen ratings across 115 factors that actually predict future performance, that have just endured a sharp price reduction. The logic isn't just, it went down, so let's buy it. It's more like, this is a great company and the share price just went on sale. That is the reason to act. The logic is sound, the math is even better. That's because our buy-the-dip strategy has delivered average annual returns of 37.85% since 2003. That is over 3 times better than the S&P 500. But more on that in a moment, right? First, I want to show you exactly what buying the dip looks like in a real year and why it's harder than it sounds on the surface. Let's roll back the clock to January 3rd, 2022. The S&P 500 hits an all-time high at 4,796. Then it starts falling. By mid-March, it's down about 12%. A lot of experienced investors were saying this was a great buying opportunity. Now, should you pull the trigger? Some do. The market then bounces, feels like the right call. Then April and May roll in and it starts falling again. By June 13th, the S&P 500 officially enters bear market territory, down more than 20% from the January high. So if you bought in March, you're now sitting on a nasty loss. Next comes the summer rally. July and August, the market climbs back sharply, nearly 17% off those June lows. Surely the worst is behind us. Except it isn't. In September, the selling resumes, and by October 12th, we find the real bottom for the S&P 500 being down 25.4% from that January high. Now, here's what that actually looked like as a decision-making sequence. You had at least 3 distinct moments across the year that looked like legitimate buy-the-dip entry points. March, June, and October. 2 of the 3 were dead wrong. Only one was the actual bottom, and you had no way to know about that until it was all over. Meanwhile, the dollar-cost averaging investor bought in every single month. Okay, they overpaid a little bit in February, but got a discount in June. And yes, they bought near the bottom in October and November. They never had to make a single prediction about where the market was going, and probably saved themselves from a few early gray hairs. By the end of 2023, when the market had fully recovered and pushed back to new highs, they'd been investing the entire time enjoying the full benefit. So was 2022 an argument against buy the dip, or an argument for doing it with a clear system and defined rules? That's the real question, and it's exactly what we'll come back to. Now let's look at what the data shows us over the past 20 years. Charles Schwab ran a study tracking 5 hypothetical investors across 2 decades, from 2003 to 2022. Each one received $2,000 per year to invest in the S&P 500. Each one used a different approach. Now the guy they call Peter Perfect, he had a superpower. He invested his $2,000 at the exact lowest point of each year. Perfect market timing every year for 20 years. His final result? A portfolio worth just over $186,000. Now we take into consideration Ashley Action. She didn't try to time anything. She invested her $2,000 on the first trading day of each year, no hesitation whatsoever. Her portfolio came in just over $170,000, only $16,000 less than Peter, the guy with perfect timing, and which we all know is impossible. Matthew Monthly used the dollar-cost averaging approach by spreading his $2,000 across 12 monthly contributions. His result was almost identical to the previous example at $166,591. Rosie Rotten had the worst timing imaginable. She always bought at the yearly peak. Even with historically bad timing, she still ended up with a little over $151,000. And lastly, we have Larry Linger, who received his $2,000 and just parked it in cash. He told himself he'd move into the market when things looked better. Yet things never looked better in Larry's estimation. After 20 years, his $40,000 in contributions had grown to only $47,000. Less than a third of what the other investors achieved. Listen up. The gap between perfect timing, which doesn't exist, and simply dollar-cost averaging was only $16,000 across 20 years. That's the entire value of getting your timing exactly right every single year for 2 decades straight. Just $16,000. That's not much across that period of time. The gap between doing anything at all versus Larry Linger's cash holding strategy, well, that's about $104,000. There's no time frame where a $104,000 deficit isn't important. That's the real takeaway from the Schwab study that I want you to internalize. It's the enormous cost of inaction that should really concern you. So if the data is clear, why do so many investors still try to time the market? Because buying the dip feels so smart. It feels disciplined. It feels like you're being patient, strategic, rather than just blindly throwing your money at the market every month. But there are two problems that buy the dippers come by that happens in real time. And before I dig into them, if you're finding this kind of insight helpful and you're not currently subscribed to our channel, well, now's a good time. It's the best way to make sure you don't miss out on my beautiful face in the next video. Just hit subscribe and the notification bell so you don't miss out any of our future videos. Okay, the first problem with buying the dip in reality is panic paralysis. The dip arrives, and instead of buying, you freeze. The market is down 15%. The news is terrible. Everyone on social media is predicting a deeper crash, and instead of deploying your cash, you just sit on your hands, and it goes back up without you being on board. This happened to countless investors in 2020 during the COVID crisis. The market crash was one of the fastest, sharpest drops in market history. On paper, it was the perfect buy the dip opportunity. But at the time, the headlines were talking about global economic collapse. The investors who froze and waited for clarity missed out on one of the fastest and most powerful recoveries in stock market history. The second problem is the idea of the false bottom. You buy what looks like a solid dip, but the market just keeps falling and falling. You now have used your cash, sitting on a nasty loss, and you don't have ammunition to buy anymore at the real bottom. This is exactly what happened in that 2022 bear market timeline I just shared with you earlier. Multiple false bottoms before the real one came in October. Dollar cost averaging easily avoids both of these pitfalls by completely removing any timing decision from the equation. Warren Buffett has said for years that for the vast majority of people, the smartest move is consistently investing in a low-cost index fund. Not because it's the highest possible return strategy, but because consistently beats intermittent brilliance over a long-term time horizon. If index funds sound a bit tame for your liking, then I've got something you'll like even better. A free special report entitled 3 Stocks to Double This Year. Get these stocks now by using the link in the description below or scan the QR code. But here's the caveat I promised you at the beginning, because Buffett's advice is aimed at the average investor. But what if you have a system that gives you a proven edge? Here's something that neither side of the debate wants to admit. Dollar cost averaging and buy the dip are not mutually exclusive. In fact, the best approach for most intermediate to advanced investors is a combination of both, with one condition that I'll explain. The framework is simple. Your foundation is consistent dollar cost averaging plan. You invest on schedule every month into quality position. That's your engine, and it's always running. It's always compounding, and it's never exposed to Larry Linger's trap of inaction. On top of that, you keep a small opportunity fund, maybe 10 to 20% of your investable capital, that you hold in reserve for significant correction. And here's the critical part. You have predefined rules for what qualifies as a dip worth acting on. Not just it feels cheap, not the market is down and I'm feeling brave, rather specific objective criteria of when to take action. For example, the stock is down 15% or more in the past month, but the Zen ratings is still an A or B, meaning the underlying fundamentals haven't changed and the bullish thesis is still intact. When those boxes are checked, you deploy from the opportunity fund. When they're not, you leave it alone and let your dollar cost averaging plan do its job. How about getting your hands on a tool that automatically hands you a focused list of the top 7 buy the dip stocks every day? Well, that's exactly what you get with our Zen Strategies service. Zen Strategies includes 11 portfolios in all, not just buy the dip, but stock portfolios for growth and value and momentum, small caps and more. The top 7 stocks each updated daily, proven, consistent outperformance. You'll find the link to learn more about the Zen strategies in the description below or scan the QR code now. Trying to deploy a buy the dip strategy without the system turns you into Larry Linger, waiting and waiting. But dip buying with a system later on top of a disciplined dollar cost averaging foundation is how you capture the upside of both strategies while minimizing the psychological landmines of each. Do you employ dollar cost averaging or do you have a system of your own? What is it and how well does it work? Please share your thoughts with our community in the comments section below. I also read all of them and look forward to replying. And for more on how to build a portfolio that outperforms the market using proven quantitative analysis, then the next video you should watch is coming up right here.